Options aren't for everyone, but for those with the risk tolerance and time to learn, they're a highly customizable and powerful instrument that can allow you to potentially profit in any market conditions, up, sideways, or down. With options, you can do things like speculate, hedge, or generate income. You can also place trades with a wide range of risk levels and probability of success. Here's what we'll cover when it comes to options. First, we'll dig into what options are and how they work. Next, we'll walk through a basic option trading strategy, the covered call. We're going to cover some technical terms and definitions here, but stick with me. Getting this foundation will make it clear why options can be so powerful. So what is an option? It's a contract that gives the owner the right or the option to buy or sell a specified number of shares of a stock, ETF, or another predetermined underlying at a certain price on or before a certain date. But why would you want to do that? Basically, it can give you more ways to potentially profit from stocks whether you own them or not. An option is what's called a derivative. That means the option derives its value from what's called an underlying security, like a stock. There are two types of options, calls and puts. Calls allow the option buyer to buy the underlying at a certain price, so buying a call is bullish. You want the stock to go up. Puts allow the option buyer to sell the underlying at a certain price, so buying a put is bearish. You expect the stock to go down. But you can also sell options. So selling a call is typically bearish, while selling a put is typically bullish. Each option contract usually represents 100 shares. This is known as the options multiplier. That's a lot of information. So let's look at an example of buying a call option to help show how it actually works. Let's say a stock XYZ is trading at $49 a share, and trader A is bullish on it. She thinks the price will go up over the next month. Trader A could just buy some shares of stock, but she could also buy a call option if she's not interested in actually owning the stock. So a call option lets her speculate on the stock's future movement without actually having to own the stock. Trader A buys a call from Trader B, who doesn't think the stock will go up. Buying this call earns Trader A the right to buy the shares of the stock from Trader B, and an agreed upon price, called a strike price, by a certain date, called expiration. For this example, let's say the strike price is $50 and the expiration is 1 month from now. Trader A is hoping the stock will go above $50 in the next month, which would make the right to buy at $50 valuable. But we'll talk about potential outcomes in a minute. In exchange for the right to buy shares at $50, Trader A pays Trader B what's called a premium. Premium is just another word for the price of the options contract. In this example, we'll say it's $2. Because a standard option contract controls 100 shares of the underlying asset, the total premium is $2 times the option multiplier of 100, or $200 per contract. This does not include transaction costs, typically a contract fee paid to the broker. So as the seller of the call, Trader B collects $200, but they're obligated to sell 100 shares of XYZ at $50 each if Trader A exercises her right to buy, which could happen at any time in the next month before expiration. Notice the difference. The buyer of the call has the right to buy the shares, and the seller of the call has the obligation to sell them. Trader A doesn't have to exercise her right. If she doesn't, Trader B won't have to sell. But if Trader A does exercise her right, Trader B must fulfill his end of the deal and sell the shares at $50 each. The option seller having to fulfill their obligation is called assignment. Looking at different ways this trade could go will help us see how this all fits together. Let's say the stock price jumps to $53. This would make the option be what's called in the money. That means Trader A could exercise her right to buy the stock at $50, a $3 discount per share. You can see why buying a call option is bullish. If the stock goes up, the call buyer has the ability to buy the stock for less than it's worth. Trader B, on the other hand, would have to sell the shares, though they would keep the $200 of premium. But what if the stock drops to $48 per share before the contract expires? In this case, the option would be what's called out of the money and would expire worthless. Why would trader A want to buy a stock at $50 if she could buy it for $48 on the open market? Trader A loses the premium she paid for the option. This is the desired outcome for trader B, who sold the call. The seller hopes the contract will expire worthless so they can keep the full premium. In this case, $200. Now there's a crucial thing to note. The example we just looked at shows what would have happened if trader A wanted to exercise a right to buy the stock and waited until expiration to do so. But many options traders don't actually intend to buy or sell the underlying. Options contracts fluctuate in value and can often be bought or sold before expiration for a profit or loss. So option buyers often buy the option hoping it will increase in value so they can sell to close the position for a profit before expiration. And option sellers often sell the option hoping they can buy to close at a much lower price or let it expire worthless and keep the full premium. The other important thing to understand is that the price of the underlying stock is a big factor in the option's value, but it isn't the only one. Time to expiration and the underlying stock's riskiness, known as implied volatility, matter too. To help clarify how these factors work, we'll look at put options and compare them to something you may be more familiar with, car insurance. With car insurance, the underlying asset is the car. The more valuable the car, the higher the premium. If you insure a Porsche, you'll have to pay more than you would with a Honda Civic. Time is also a factor. Some choose to pay car insurance every month, while others pay every 6 months. The longer the time, the higher the premium. And don't forget about risk. Insurance companies look at certain characteristics of drivers to determine how risky they are. For example, teenagers are usually considered riskier than, say, more mature, responsible drivers. Much to parents' dismay, an insurance contract will likely be more expensive for teenagers. These factors are very similar for an options contract. The price of the underlying asset is the most significant factor. Options tend to be more expensive when the underlying stock costs $700 rather than $10. Also, time is an important element. The more time between now and when the option expires, the more expensive the contract. And lastly, there's implied volatility. Some stocks and ETFs are riskier than others. Some stocks like biotechs, for example, could be considered the teenagers of the investing world, while blue chips with healthy dividends are more like mature, stable elders of